Welcome to Money Moves, presented by F&M Trust. My name is Matthew Berger. I'll be a regional market manager with our investment and trust department, serving Franklin, Fulton, and Huntington counties. And I'm joined today by my colleague.
I'm Erin Sunday. I'm a relationship manager, also with the Investment and Trust Services Group of F&M Trust, and I serve the Cumberland and Capital markets.
In this segment, we're going to be talking about changes or proposed changes to the personal income tax schedule. Erin, maybe you could lead us through some of those proposed changes.
Yeah, one of the proposed income tax changes is for our high-earning individuals, those making $400,000 as a single individual or $450,000 married filing jointly. That top marginal tax rate is going to increase from 37 to 39.6%. In addition, they want to have a 3% surtax on any incomes over $5 million.
We're also talking about modifications to rules relating to retirement plans. And these are really rules to limit retirement plan benefits for individuals who have accumulated what they're defining as very high balances. And these would be balances exceeding $10 million between their various retirement plans. So these contributions are, first they're going to limit contributions for those in those same high tax brackets. And we're also talking about required minimum distributions possibly being implemented on those higher balances. So for those who have had their retirement accounts grow in excess of $20 million, there's actually a discussion about having a required minimum distribution immediately starting the year after where you hit that number, where it's going to be 100% of the amount that's in that retirement plan over $20 million. They're also discussing about charging or having a required minimum distribution for those who are in that $10 to $20 million range of half the amount that is in excess of $10 million, really looking to limit those IRA and retirement account holders who have those higher balances.
I think a lot of these changes arose out of the administration and Congress getting wind of IRA account balances growing to billions of dollars, and that's big billions. So they want to look at how do they combat that.
Yes, and we're also talking about limitations to certain investments that can be held in retirement accounts. Anything that is described as a accredited investor-only investment. So I want you to think of hedge funds. Well, some of those more aggressive investments will no longer be allowed to be held in your IRA. Also, if there are business interests, private business interests for which you had previously, the number was 50%. If your interest was greater than 50, that would be disallowed. Now they're talking about lowering that number to 10%. So any ownership in a privately held business over 10% would now be a disallowed transaction. We're also looking at possibility of losing what was a great planning vehicle for our higher income individuals, and that is the backdoor Roth conversion. So there is an income limit over $195,000, $199,000. You start to see a phase out there where you no longer are able to contribute to a Roth IRA, but a lot of financial advisors have been able to get around that through the backdoor Roth conversion because there were no income limits on doing a Roth conversion. That looks to be going away with these new tax rules.
Aren't there some new proposals about how to report these things as well?
Yes, so we're seeing a reporting requirement. So once your retirement account balances grow in excess of $2.5 million, the IRS is going to be requiring your IRA custodian to start reporting that balance number.
And interestingly enough, in recent years, we have seen funding to the IRS going way down. Currently, under the Biden administration, they want to increase the funding to the IRS in order to go after fraud and delinquency, in order to raise those tax revenues.
Yes, and that number they're discussing is $80 billion, roughly, for the IRS, specifically to go after these individuals making more than $400,000 a year. So our recommendation, if you are someone in one of these higher income tax brackets, there could be changes coming to how you can contribute to your retirement plans, certainly to the rate of tax that you'll be paying on your income. So we recommend you get together with your tax professional, with possibly your investment professionals, maybe the person who is managing your retirement plan on behalf of your business to discuss how these changes could impact you. Thank you again for joining us here on Money Moves, and we look forward to seeing you in future segments.